So in my estimate, I increased cash costs from 1,000, like 15% to about 1,150 to accommodate for higher inflation. But the gold price that's going to get us there is, 4,150, $4,500 an ounce. And cycles always repeat, and we're definitely going to get back there.
Welcome back to Metals and Miners. I'm its founder and its host, Gary Bohm. We have a fantastic discussion lined up today that I'm super excited about. Today, we're fortunate to have with us Garrett Goggin. Garrett has been a derivatives trader, statistical arbitrage equity trader, and a portfolio manager in his storied financial career. Garrett worked with the legendary John Doody of Gold Stock Analyst and investment research powerhouse Stansberry Research for nearly 15 years. He's keynoted many of the world's preeminent gold conferences over the last several decades. Garrett is sought by many leading gold and silver developers for his top shelf research and coverage. He is a chartered financial analyst charter holder. There's only, or maybe less than 200,000 total charter holders worldwide. Garrett knows really almost everything there is to know about investing in gold. And he's recently gone independent in order to share his proprietary gold portfolio with you, which can be found at thegoldenportfolio.com. Garrett, thank you so much for joining us today.
Hey, Gary, I appreciate it. I'm excited to be here, and thanks for the nice introduction.
All right, yeah. All right, let's begin with the U.S. dollar. Is it just a matter of time before a decline in the U.S. dollar accelerates, devastating purchasing power? In other words, do you foresee paper currency devastation versus gold and silver as inevitable?
Yeah, we were just talking about that before, the interview started. What's the end result? Is it going to be, the stock market decline, loss of, real assets? But, I believe that due to inflation, we possibly could see, the Dow at 100,000. We could see gold at 5,000. It's just continued loss of purchasing power. But a bottle of Coke is going to cost $25. And, we're seeing that right now. I got 3 little kids at home. And just over the past couple of years, right? Like we go to Costco, we go to Publix, and all the food prices, they've doubled. And people are getting hammered. I travel all over the country. I travel all over the world. It's the same story everywhere. People are losing purchasing power left and right, and a lot of people can't figure it out. It's I was just in Zurich, and it's interesting going over there because they have a rich history of wars and devaluation and loss of currencies coming and going. And you ask the average American, like, what's a dollar worth? And they say, it's a dollar. What do you mean? A dollar's a dollar. But no, it's not. A dollar's worth, 91 Swiss francs. It's worth whatever, 94 euros, it's worth 78 British pounds. You got to think of it like that. But one of the interesting things regarding the currencies is, they use the dollar as the yardstick. And if you look at anything we measure, you look at pounds, kilograms, kilometers, yards, meters, there's a standard for that. And they keep that standard where, like in France somewhere in some museum, where they get a standard kilogram, and that never changes. But the yardstick that they use to measure currencies is a US dollar that's continuous losing purchase power. So if they all devalue at the same time, the values stay relatively the same versus each other. But all the currencies losing value to assets with real value, in particular gold. And that's why we're seeing the run up right now.
Yeah, that's amazing. I appreciate you pointing that out. So the ratio between the dollar and other currencies seem to stay the same, but unfortunately, the dollar is continually fluctuating, unlike a mile, a kilometer, et cetera. So it'd be nice if they use something that wouldn't change, maybe gold.
Oh,
yeah. Garrett, we can, based on what you were just saying, we can all see rising prices everywhere, and we could definitely sense that something is way off, but it seems like most don't fully understand all the ramifications of the endless money printing that the Fed has done and likely will continue to do. As inflation is higher for longer, what does this mean for the bottom half of consumers who are already stretched? And then how do you see the government responding?
It's tough. It's definitely affecting the bottom half. the salaries haven't kept up with salary and wages haven't kept up with inflation. And, with the higher real estate prices and the higher food prices, people are scraping by in order to make ends meet. And then, the way the government always responds is by providing more stimulus, some sort of, mandatory income that people will get. And in the end, it's just going to lead to higher deficits, higher money printing, and that's the direction we're going in.
Well, and I could see with that why it would lead to 100,000, in the Dow, it's, et cetera. All right. So so you don't see a coming major stock market decline, but in the scenario you're describing, how will the Fed, gold, and gold stocks respond, and how should investors be positioning right now for that $100,000 Dow?
No fever like gold fever. What this shows is the yield curve. It's the 10-year minus the 2-year. This shows whether the Fed is tightening or easing. Now, there's been 3, 4 periods back to 2000 where the Fed has been extremely tight. It happened in 2000, it happened in 2008-ish, and it happened in 2019, and it's happening now. The yield curve flipped negative. Short-term rates are higher than long-term rates because the Fed keeps them artificially high and the economy isn't doing too well, so the yield on the long terms is lower. So we got a negative yield curve. Every time we've had a negative yield curve, there's been a major financial debacle. In 2000, it was the dot-com bubble. 2008, the absolute economic disaster. 2019 was the taper tantrum. Right now, 2024, we haven't had our financial disaster yet, but it's coming because economic conditions are too tight and the economy can't function because there's too much debt out there. And then what I've been seeing recently over the past few months, I'm just, kind of spitballing it. I'm like, everything appears to be okay, but, what could possibly be the trigger for the next Fed rate cut? And that's an important thing too. Everyone's like, all right, the Fed's going to cut rates. But you know what? The Fed only cuts rates when they have to cut rates. If the economy's doing great and the stock market's doing great and it continues higher, the Fed's never going to cut rates.
No.
They only cut when there's an absolute calamity and stock market's collapsing and the economy's collapsing. And what I've seen recently, commercial real estate, there's maybe 5 or 6 major banks that their large percentage of lending is commercial real estate. Commercial real estate is getting smoked around the country. We're talking Massachusetts, New York, California, Florida. All the office buildings are selling for 20% of what they went for like 3, 4, 5 years ago. $200 million buildings are being sold right now for $25 million. These are creating massive $100 million holes in these banks' balance sheets. And if you look at their share prices, it's like Huntington Bank shares, New York Community Bank shares, and there's a few of them, they're cratering. And I think that is going to leave a hole. And there's, I think, $3 trillion worth of commercial real estate loans coming due over the next couple of years. And now rates are 3 times higher. It's over. These banks are toast. Their equity's worth nothing. Their liabilities, the Fed's going to have to step in, provide a lot more trillions of dollars stimulus. That's going to, the commercial real estate disaster is going to cause the next leg down in the stock market. The economy is going to be freaked out, and that's going to cause the Fed to jump in, provide trillions of stimulus, and cut rates and push the gold market higher at that point.
There's a lot of people who say that this particular metric is broken, that it's been 650 days. The yield curve hasn't proven to be an issue, and so it's not a metric that we should be taking seriously anymore. You evidently don't subscribe to that.
No, it's been that way for 100 years. Why is this time different? This time's always different until everything collapses on your head.
Right. Yeah. Okay. So some are saying that higher interest rates have pushed investors away from gold and into treasuries. Okay. So has the 5.25% interest rate played a role in Western investors not buying gold? In other words, has the higher interest rates been prohibitive for them to buy gold and instead move them to owning short-term treasury bills to get the interest from the paper, but by virtue in the end of the rates staying higher for longer, will they eventually wake up and then see that they chose 5.25% interest over 2,500, 3,000, maybe even much higher gold values?
Yeah, I think that's what gold's signaling right now. There's a lot of people with a lot of assets, and that 5% yield is extremely attractive. And regarding back to my first conversation, the average U.S. investor doesn't understand their loss of purchasing power. A dollar is a dollar. So if you got $1 million, now you got $1,050,000. 50,000. Hey, I made 50,000. Yeah, but did you really? What's your loss of purchasing power? And it's interesting. Going over to Zurich, they love gold. Their investors have been through hundreds of years of instability. And some of these guys, they have vaults in like the Matterhorn, full of gold, and full of stock certificates. Like these guys, they do not care about interest. They don't care about dividends. All they care about is preservation of purchasing power. And the way they do that is, holding gold.
Mm-hmm. Yeah. So recently you wrote that gold is going to go to 4,500, and on dips, we should buy for the big run higher that is coming. Garrett, will you share your thesis on why gold is going to 4,500 and what your anticipated time frame is?
Yeah, all right. This is a long story. I'll make it shorter. But let me pull up one of my charts. I hate throwing out predictions. 4,000, 5,000, 10,000. There's like anyone, it's an opinion. Anyone can say whatever they want. There's no data behind it or anything like that. I got some data, so it's based on something. Let me show you what it's based on. GDX, gold miner ETF, versus operating cash flow margin for the miners. Now, right now, it basically costs the miners $1,000 an ounce to get it out of the ground. Gold's trading for $2,300 an ounce. So the margins are, about 55%. Now, if you look back in this chart, you'll see in 2011, margins peaked out at 72%. In order to get back to those 72% margins with the cash cost at $1,000, plus, it would take 4,100, a gold price of $4,100 an ounce. And cash costs and input prices, they never go down. Like they might maintain stable for a quarter or two, but they're always driving higher. So in my estimate, I increased cash costs from 1,000, like 15% to about 1,150 to accommodate for higher inflation. But the gold price that's going to get us there is, $4,150, $4,500 an ounce. And cycles always repeat, and we're definitely going to get back there. The negative yield curve. Every time the yield curve has gone negative, gold's doubled. 2000, it doubled. 2008, it's doubled again. 2019, it doubled really quickly. And you know what? It's going to double again right here. 2,000 to 4,000.
Okay.
We just need the trigger, the economic calamity trigger to get the Fed to provide the stimulus and cut rates, and then we're going off to the races.
Okay, and for you, the trigger is likely commercial real estate meltdown, but it doesn't have to be that.
Yeah,
but that's your likely one.
Yeah, that's my story right now. But who knows? It could be anything. And
well, and there's plenty on the horizon to potentially be the trigger.
Absolutely. And then the other thing, my phone started blowing up the other night, right when the bombs dropped, and in Iran, and everyone's like, hey, what's the best way to get involved in gold, blah, blah, blah. And usually when that happens, it's like, it marks a peak in gold. And I follow the commitment of traders very closely, and I follow managed money and commercial traders. And, managed money's really run up there. Commercials are getting really short here. Short term here, I wouldn't be surprised to see gold pull back as we're seeing it pull back right now. But if you look at a gold seasonality chart, we get a run up in the spring, it pulls back in the summer, and then June and July, we get our next leg higher through a strong close of the year. And that's what I think is going to happen again this year.
Okay. So gold has closed at an all-time high on more than half of all trading days over the past month or so.
Yeah.
On similar prior surges, it was higher 6 months later each and every time.
Yeah.
So is this signaling something similar to you? Are you looking at that saying, yeah, we might have a short-term dip here, but in 6 months, I fully expect it to be much higher?
You know the turtle traders, you know, Richard Dennis. Yeah, have you heard that whole story? And those get traders in Chicago.
Why don't you go ahead and share it?
These were futures traders in Chicago, and this happened back in the 70s. You know the movie Trading Places with Eddie Murphy?
Oh yeah.
Two brothers had a bet, and they go, I can bet you $1 we can train anyone how to trade. Well,
Uh-huh.
these guys saw that movie and they're like, you know what? We can teach people how to trade. And they assembled like you know, 100, couple hundred turtles, and you know, only a few could follow the rules. And then the kids that follow the rules ended up making hundreds of millions of dollars. But the reason why a lot of people weren't able to follow the rules is because they were so simple, and human nature didn't allow them to. And a lot of people believe that the Richard Dennis and the guys running it were holding back information from them. The only rules that the turtle traders had were, if it reaches a 20-day high, you buy. If it reaches a 20-day low, you short, and then you just ride it for as long as you can. And you had, you know, risk adjusted stop losses and stuff like that. And when your long position falls back to a 15-day low, you would sell it, and vice versa on the short position. That's it. There's four rules. And if you look at, you know, what you're talking about now, and if you look at this chart, daily highs, weekly highs, quarterly highs, yearly highs, all-time highs. Last time it happened was 2008, 2009, gold doubled, and we just had that, you know, breakout right here again. So you don't know which trend is going to be the one that's going to take you higher, but you want to be aware of all-time highs, and you want to be on the correct side of that trend. So yeah, and you know, we could have a small pullback here, and the end of the year is going to be strong.
So what's interesting is looking at where you put the red lines here on the chart. The first one, starting around halfway through '05 into '06.
Yeah.
Before that first run up there, which is in '07,
Uh-huh.
feels very similar to where we are now. It pulled back to
Absolutely.
that. It pulled back to that breakout point,
Yeah.
and then it was off to the races.
Yeah, that's it. Exactly. And it's hard to predict the short-term trends, but you know, the long term's up. And then regarding being on the correct side of, you know, like it's a freight train. It's you want to get on board. The turtle traders, like they trade a lot of futures, financial instruments, including cocoa. And we saw what cocoa did. Cocoa went
Hmm.
from, you know, 4,000 to 10,000. This chart's dated. It went up higher. It went to 10,000. And if you just stay on the correct side of that trend and just walk away and forget about it and go to sleep, you know, that's where you want to be, because some of these large moves, they continue way further than what people expect.
So your projection to 4,500, do you feel it follows a similar pathway where that might be the projected point, but it can go way further than that?
Yeah, if it could go much higher if, you know, if it really gets going and the economy gets out of control and inflation gets out of control. We saw how much money the Fed printed during the last economic debacle. They printed
Right.
what, 4 trillion, 5 trillion. If we get a bad one here, like the gloves are off. We're trillions and trillions and trillions and trillions and trillions, and we ain't going back to a smaller government. They're not going to stop spending money. It's getting
No,
worse.
I agree. All right, Garrett, it really seems that we're in a period similar to the 1970s where central banks were exchanging dollars for gold. A few months ago, gold breached, like you just showed, the 4-year consolidation zone of 1,600 to 2,000, and it's reached over 2,400 in just the last few weeks. My question to you is, what is gold really trying to tell us with this move?
That inflation's here, inflation's real, it's not going anywhere, and you need to protect yourself. You know, they measure inflation on a year-over-year basis, right? It's, you know, 2.2%, 3.3%. But you know what? It never goes down. You never get negative inflation.
Right.
Just because, you know, you get, say you get 1% or 0% inflation, still food prices are still twice as much of what they were, you know, 2 years ago.
And they don't recede.
No.
No.
Yeah.
Yeah. So is there a plausible scenario where central banks are currently suppressing the price of gold in order to be able to acquire more for their balance sheets at lower prices? And once they remove the suppression, that there'll be some kind of springboard effect on the price of gold?
Yeah. You know, I like some conspiracy theories, and you know, others I don't. But there's definitely something to be said about, you know, the GLD ETF and gold futures. We've recently seen this with Bitcoin. People are pretty amped up on Bitcoin. They think of it as, digital gold and stuff like that. But yeah, Bitcoin was freely traded and it wasn't brought in the financial system until the past year. Now we have ETFs. Now we have futures. And you know what? Watch what's going to happen with the price of Bitcoin due to all the hedging and all the bank interference and all the investment bank interference, managing their books and managing their orders. And it's like a price management. I don't know if it's an official government stance. Like I've seen the documents and all that, and I agree with it. And if you keep gold's the barometer of the currency's value, and if gold goes wacky, people lose faith in the currency overnight. And they say there's no fever like gold fever because people freak out. So, I agree with you. It's in the government's best interest to, keep gold prices under control. I think we're coming closely to a time where it could get out of control.
Okay, so I was going to ask you, do you think that's going to happen? You just answered that. But regarding the Bitcoin comment that you made, you said, watch what happens to it now that it's being managed and there's interference.
Yeah.
What do you expect to happen?
The volatility is going to go away and all the price gains are going to go away and it's all going to be dampened and it's going to become a, traditional financial product.
Interesting. Okay,
Yeah.
well, that'll be something for all of us to be watching.
Yeah.
Garrett, you've recently stated on Twitter, X, that you have a gold portfolio that rose 13,096% since 2007, that it's a 31.2% compound annual growth rate. It's better than Buffett, better than Soros, better than Druckenmiller. It's a simple long-term equity portfolio. It's the ultimate gold investment, and that nothing compares. Will you speak into that for us?
Yeah. How much time you got? All
Well,
right.
give us the condensed version.
All right. This chart shows gold versus all the major miners. Gold's up top. All the major miners, they lag the price of gold over the past 20 years. And some people think it's an undervaluation gap. It's not, because if you look back over 50 years, that ratio between gold and miners, it's declined steadily over 50 years. This is a trend that isn't going to change, and I'll tell you more as I go on. But you do get rallies in this ratio. It'll get doubles and triples where the major miners they'll go up 2x, they'll go up 3x. But in the end, they roll down. And at the heart of it, it comes down to profitability. Mining is an extremely tough business. You are spending hundreds of millions of dollars. You're spending, say, $500 million of capex. You're spending a tremendous amount of cost every single day. And then you're getting the gold, and you're relying upon the price of the metal to provide your profits. And miners, they have a hard time making money. You look at Newmont. Newmont, paid out a dividend all last year. They didn't make enough free cash flow to even cover that dividend for the whole year. So as a result, the miners are forced to dilute to keep issuing more shares, and that results in lower earnings per share, and that results in a declining share price for the major miners. And then, this is like the heart of my chart. When gold rises, it's because of inflation. And as, inflation pushes gold higher, it pushes cash costs higher for the miners, input costs, the cost of labor, the cost of oil, the cost of everything. So even though the price of gold has basically gone up, 4x since 2002, miner margins are the same as where they were back 20 years ago. They were like 50%. And at the peak in 2011, they were as high as 72%. And, I think gold's going to rise up, and the miners are going to end up, profiting, and the margins are going to get back there. And the GDX is going to double and triple. But the thing is, I have a better way. I've been doing this research. I've been covering 80 companies for 15 years. I'm a CFA, I'm an MBA, I'm from Boston, institutional community, and I just see the lack of profitability in the miners. But there is a sector within the mining industry. I call them, IPMs, inflation protection machines. But what they are the royalty companies. You get a couple big ones. You get Wheaton, you get Royal, you get Franco. Franco's the king of the royalty industry. These guys are structured to get lucky. for many, many different ways. For number one, their costs are fixed. Pierre Lassonde, who started Franco, they were an explorer, and then they got sick of wasting shareholders' money, so they took I think like $202 million, and then they founded a royalty in the Elko Gazette back in like the late 70s in a newspaper, and it was a royalty on Goldstrike, which is one of Newmont's big mines. And they purchased it, and the Goldstrike ended up becoming a mine, hundreds of thousands of millions of ounces. It's provided so much cash flow for Franco-Nevada over the years. They probably got like close to $1 billion from this initial $2 million investment. And then as the mine grew, Franco never had to put up any more money. That initial $2 million investment covered that 1.5% NSR for the life of mine. So as you have direct ownership, a percentage share of the asset, and as they explore more, you get free upside, and then your costs never go up because you never pay any more money as it goes on. And then there's like 3 or 4 reasons a royalty company could be run by 3 or 4 people. You get a lawyer, you get a banker, you get a finance guy, you get a geologist. There's your royalty company. Miners, there's 200 or 300 miners and employees, and the costs are so much higher. So for a royalty company, the margins are unconstrained and extremely high. And
so did you have a royalty company that grew by 13,000% since 2007?
yeah, well, I tell you what, the Franco's gone up 7x. Wheaton Precious has gone up, I don't know, 6x, 7x. But one of the major things that really drives the returns of the golden portfolio is the consolidation within the sector. You got major royalties, the big guys, and then you have smaller guys that are trading for about $100 million. Now, the bigger royalties, they need big deals of, $1 billion, 500 million and up to really move the needle for them. The smaller royalty deals, they don't necessarily care about, but these smaller royalty companies do. So they go around, they do the hard work. They're, in public libraries, they're tracking down old royalties that, pass from grandfather to, grandchild. And they'll pay for these royalties, in smaller deals, $1 million, $2 million, $3 million, $5 million. But what happens is, they build this portfolio of assets, and then 1 or 2 of them end up like growing into something serious. And then the major royalties start getting interested, and then they come in and they take that little guy right out. And I've seen 3 waves of consolidation within the sector over the past 15 years. I've seen one of my favorites was Abitibi Royalties. The CEO was Ian Ball. They owned royalty on Canadian Malartic, I believe. And then in the deal, they got shares of Yamana, they got shares of Agnico. They sold calls on those shares. They used that money to buy back stock. And then, Canadian Malartic ended up growing into a monster. And this company went from 0 to like hundreds of millions of dollars overnight. And the share price went from 20 cents and it got taken out to like $21 a share.
Wow.
Yeah. And one other thing regarding the royalties, a mining company is if you have, if you have one mine that goes bad for your mining company, your equity's toast, because most miners have 1 mine or 2 mines. The big ones have like 5 or 10 or 20, but the majority of them are small, 1 or 2. And if you have issues with that 1 mine, you are done. The shares are going to plummet. But with a royalty company, I think Franco-Nevada has about, I don't know, 350, 360, NSRs and royalties, and all they need are 1 or 2 of them or 3 of them to do well. The rest of them could do nothing, and they're still going to make a killing.
Yeah, it's amazing. So the last decade has really shown that retail investors have none to very limited interest in gold, and instead they seem to want crypto. Gold prices are now on the move. Is gold in a situation where it won't peak until retail interest explodes in a panicked frenzy of price and emotion? And what will it take to get there?
Yeah, that's basically one of my Twitter posts. So I look at GLD shares outstanding. Each GLD share entitles you to, I don't know, 10,000 ounces of gold. So the shares directly convert in ounces. And then if you look at a chart of, the gold price versus GLD holdings, it tracks pretty well. So that when the shares explode higher, like the creation baskets, they got to create more shares with the money coming in. The gold price spikes higher, the shares spike higher. And we've seen that ever since the GDX was implemented, like for 20, 30 years. However, now what we see is the shares keep declining and gold's price has been advancing. And, that's a sign of the retail investor does not care about the price of gold right now. And every other major peak in gold, it was marked by massive retail frenzy. So many shares of the GL, there was so much demand that they'd create so many shares, created a large spike up. And we are at the opposite end of that right now. Like nobody is interested.
Nobody's interested. So I think the long-term historical mean is 2 to 3% ownership. I think during the great financial crisis, it got somewhere between 7, 8, 9%. And as far as I last heard, we're somewhere under 0.5% metals ownership, stocks and metals currently. So, I mean, clearly people are not interested, but you're saying you think this is going to flip and people are going to become very interested.
Yeah, no doubt that, that's how bubbles end, when everyone gets interested, as we've seen with AI and, NVIDIA, recently, when everyone's talking about and everyone's involved, that's usually creates the, blow off, top. And we're nowhere near that. People are just unaware. People are stumbling around. They can't make ends meet. They just see the higher price of everything and they're not connecting the dots yet. And this whole thing, this whole freight train's not going to stop until people finally understand what's going. They need to own real assets, and they lose faith in the dollar and, to buy gold. And we've seen it happen in countries all over the world. And, eventually at some point it's going to happen in the US where people are going to lose faith in the dollar. And yeah, they're going to try to convert as quickly as possible.
Yeah, it's kind of sad though for the masses. All right, so Garrett, if gold is going to make a huge move to 4,500 minimum, as you're expecting, and a good many of those who have invested in crypto are going to rotate into gold, clearly sentiment in gold is going to undergo a historical shift. Do you see that sentiment shift alone creating a quote unquote rising tide raises all boats scenario for the miners? And yes, the cost will hit the bottom line as inflation continues higher, but the explosive move to 4,500 will outpace the rising cost for a period of time, while at the same time, sentiment in the sector will explode higher, likely leading to what I would say is huge investments in stocks that contain the word gold in it.
Yeah. I'm a believer. We're gonna have something that happened like in the '70s when the U.S. got off the gold standard back in the '70s, and we're moving towards a crisis like that right now where people are gonna lose faith in the dollar. People wait a long time, but I just gold signaling and making daily, weekly, all-time new highs, and it's signaling what's gonna happen next. And yeah, I think people are definitely going to come back from crypto. I think it's going to be a mania. We're going to have a lot of the smaller stocks. The golden portfolio that I'm running is, royalty based, but I also offer another product, the Mnt&x, that are focused on the smaller companies that are leveraged to price of gold. The main way you can add value in the gold sector is through exploration. Whether you're a major or a smaller guy, you need good drill results. If you have good drill results and you can show that you have a interest in resource, you can create hundreds of millions of dollars of value overnight. So my Mnt&x focuses on these smaller guys with good drill results and with good grade. And these guys, they couldn't raise money last year. Some of these companies are, they're being funded by the executive, the CEO and the CFO's credit cards because they're going out to market and they haven't been able to get any financing. But it's starting to heat up now. And then going to PDAC, like I was walking around talking to a lot of companies with 1 mil, 2 mil, 3 mil, 5 million ounces of resource or reserve, in the ground, and the company's trading for $25 million or $50 million market cap. Like I've never seen anything like that. And the sentiment's changing. Like The Thursday before PDAC in February, the gold price was down 25.50. It was like, oh, here we go. It looked like it was going down. But then Friday it went up $50. Monday it went up $50. And that's when that run started. And it happens quickly. And one of the companies that I follow, the Reunion Gold just in Guyana, they had a good resource, they got good grade, they just got taken out today for, I don't know, $600 million by G2 Goldfields. And we're going to see more and more consolidation within the industry because the majors have been cutting back, they've been fixing their balance sheets, they've been selling assets, and they're not able to generate any growth. And the only way they can do that is by going after the smaller guys to build new mines.
Yeah. So do you see this when it enters this mania phase, like it has for other assets? We saw it with NVIDIA and all things AI just recently. But when it enters the mania phase, do you see it as you still have to be picking the right stock, or do you see this as a rising tide raises all boats? If it's got gold in it, it's going up. I want to point everyone over to our Substack. It's free. Go to metalsandminers.substack.com. We post free content on the consumer, economy, markets, artificial intelligence, individual metals and miners, and of course, all of the interviews that we conduct. And when you subscribe, we want to give you a free gift. It's a report that we wrote based on an important Ray Dalio foundational premise titled, "If you don't own gold, you know neither history nor economics." This free gift is a must read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address to subscribe. It's free, and get the free gift.